All right, my name is Daryl Martin with ApexInvesting.com, and I wanted to thank you for joining me on this presentation today at Spread Foundations. And today we're going to talk about implied volatility, or IV, also known as expected movement. Okay, and the measurement, the math formula is called Vega, and that's simply, it's the most important option in Greek, and it literally can move things more than anything else can. Okay, more than delta, more than time, more than movement. Vega is the most powerful. It also has more of an impact on options that are further from expiration. So a 1 day spread versus like a 1 hour spread actually would have more impact by implied volatility. And it will also be impacted by things like news. Okay? For example, you may see like a 1 o'clock spread has barely any proximity or premium in it, but a 3 o'clock spread may have a lot of premium proximity in it. Why? Because let's say Fed funds rates coming out at 2 o'clock. That is the implied volatility, that expected movement priced into the option. So it'll actually, again, that Vega is higher the further it is from expiration, and can make it further away from the money. Implied volatility can actually be charted. Not on spread so much because it's more of a daily charting type thing you do, but you can see it in just the option pricing itself. And you can see it by really looking at premium and seeing how high premium is on contracts that are in the spread. And if you see really high premium, there's really high implied volatility. If you see really high proximity, there's probably really high implied volatility. Okay? So looking at either implied volatility looking at high premium and high implied volatility will show you high premium and high proximity will show you that there's a lot of IV, especially if like all the contracts have a lot in it, besides maybe like the ones that are right near the market, but every other contract has a lot in it. Like when you look at NASDAQ, you'll see a lot of premium in it. That's because it has a lot of implied volatility, and it's a really narrow spread. So again, it's based on the demand for the contract. So I've even seen, if you hop in a contract and then tons of people start hopping in the same contract, I call trades out on the radio, stuff like that. Sometimes you'll see it move a little bit just based on the demand. Now, you won't see it move too much, but I've seen it move actually some, maybe like $10. It has to be pretty high, hundreds and hundreds, or thousands and thousands, depending upon the kind of contract it is. But the demand can increase it somewhat. Okay, it can actually change the value. But really, it's the demand based on how much expected movement there is. The more expected movement, the more people use options. The more people use options, that's how they actually measure implied volatility. So, if Vega is 0.05, then for every 1 cent change, or 0.01 change in IB, the option will increase or decrease by, say, a value of 5 cents. Okay? Or it could be $5, or, whatever. Just depending upon the type of contract it is. So, now, something else you can see is what's called a volatility crush. And that's like if you buy an option on high volatility, high premium, and the volatility drops really fast. Well, when could that happen? Let's say you bought a call on Apple the day before earnings. Well, the IV is going to be really high. Okay? But after the earnings announcement comes out, the move happens and the IV could drop, massively, and could actually overpower the movement you had in the underlying market. So you could also see this happen like news announcements about to come up. And so IV's high, like a government news announcement that's expected. So there's potentially expected movement built into the price. And then it comes out, and let's just say it's a non-event. Then all of a sudden you see it drop down. Okay, and then the premium could sort of disappear. Now, if the movement is large enough, it could, absorb that. But if it's not large enough and that comes out, then you can see it definitely drop in price a lot. Here is actually an example for you with Apple, and it's showing you earnings dates. Okay, and there can also be other times when the market's crashing can make it also, of course, spike up. But there's earnings that's building up and then it drops off. Earnings is coming out, builds up and drops off. Earnings is coming out, it's building up to it, and then it drops off. And notice, even though the market went down, the IV also went down, which usually you see the IV go up when the market goes down. But it's after earnings. So here you see, it's rising going into earnings, and then earnings comes out and it drops off. And that's an IV bubble and an IV crash. And you actually can see that throughout the day when there's certain news announcements how IV will be higher and then it'll be lower. And it'll usually be built into the expiration itself. So it won't change a whole lot on that contract. It'll be more based on the news announcements and what the expected movement is from it. So again, some of the clarifications. Vega is a measure of price change on the implied volatility changing or expected movement changing. Okay. Again, IV means implied volatility, which is a fancy word for expected movement. If the IV rises, you're going to see more premium come into the contract. If it falls, you're going to see premium fall out of the contract. Again, before news, premium can overrule things. It can even overrule time decay and movement. So again, this has more impact than all the Greeks, but it has less and less impact the closer you get to expiration. Okay? So we can look at a contract with really low implied volatility. And like say the euro dollar not having a lot. And notice how like we're seeing contracts that are 10 minutes, 1 hour, 6 hours, 14 hours, not having really that much proximity or premium. We even see, the like low risk contracts don't have that many. The ones that have like the one that expires in 14 hours, okay, and only is risking $28. Only $17 of that is actual premium. So there's not that much implied volatility built in. It has low IV, low expected movement. Doesn't mean you can't make money on it. You can make plenty and it can be, awesome. I'm just saying that the option pricing lets you know, hey, the IV is low. That low proximity, that low premium is that IV being low, especially when you see it across the board on multiple expirations on multiple contracts. Now we can go to the opposite side, so that has high IV. Let's look at NASDAQ over here. And you see how all of these contracts have quite a bit. There's a few that are lower, that are right in the center. Okay? Like that first one there, it's like, $9 a premium, 4 ticks of proximity. Like it's right in almost in the center of the bid offer. That's why you see it's like risk 42 to make 50. Okay? But you go down and you scroll down further, and you'll notice all of a sudden like it gets bigger and bigger and bigger. With a very small move, that thing went from $9 to $17 in premium. Or on the sell side, went from $3 to $28 in premium. And it's just moved a little bit away from the center. But it's not just the short-term expirations. We see it in the long-term expirations. We even see it in the really long-term one, the 5-hour one down at the end of the day, that even though there is a lot of time and a lot of room, we're still seeing like, $50 a premium, $60 a premium, $120 a premium, even though there's quite a bit of movement potential left on both sides. So when you see that much premium, it's a high IV contract, and you may want to use caution in using that contract, especially when you see it all the way up and down the strike ladder on just about every single contract, because that means that contract is going to move slower. It's going to be a little harder to trade. I'm not saying the underlying market moves slow. NASDAQ obviously doesn't move slow or isn't currently. But what? Think about it. The contract, the bid offer is going to change slow. How do I know that? Because all of the premiums and proximities are high. Okay? So, these are in the spread, deep in the spread, out of the spread. Like, there's a variety of contracts on here. But it's going to move slow. All right? So just keep that. Be aware of that. When you see that high premium, high proximity, it's going to be slow. And if you see it across the board, expect it to move, the price of the contract to move slow. And if you get that down, that'll help you a ton. And again, if it's low, expect the price of the contract to move fast. So you may be like, hey, I'll just take this $28 one because it's going to catch up really quick. Down here at the bottom, right? So that is a short lesson for you, but an important lesson for you, and a visual representation for you of implied volatility and how important it is in the spread contract to know how fast the contract itself will move. Okay? This is Daryl Martin with ApexInvesting.com. Make sure to check out our other videos, and I look forward to helping you out.